On Wednesday, October the 30th, 2024, Rachel Reeves, the new Labour Chancellor, will deliver her first budget. Today, we're going to attempt to do something notoriously difficult, which is predict the future by thinking about what changes could be introduced in this budget and think about how this may affect your finances. And to do this, I'm joined by the best that MedicsMoney has to offer, and you could say the best of the best. Andy and Ed, how are you guys? All right?
Yeah, not bad. Thank you, Tommy. How are you?
I am brilliant, mainly because, well, we've all been on holiday a lot this summer. Ed's just got back from Vegas and you have returned, so safe to assume that you didn't win big and you are coming back to work with us.
Yeah, sadly, no big winnings this time round. Maybe next time.
Yeah,
Sure.
I've also checked the zero account just to check he hasn't actually spent all the MedicsMoney funds.
Oh, I was hoping I'd get away with it as well.
I said it was fine to spend it as long as you win, but yeah. And me and Andy have also been on holiday to the same place, but probably good to point out not at the same time, because that would be a bit strange.
Yeah, that was a little weird. But thankfully you left the resort in situ for me when I turned up 2 weeks later.
Well, it's because I hardly went to the resort. I turned up, jumped on the yacht and headed out to sea, so I couldn't do too much damage. Although, yeah, avoid the kids' pool at all costs. That's what I'll say. Yeah, I mean, my daughter just didn't realize that she'd done a wee, basically. So after that, let's just move on swiftly to talk about the budget that is coming up, because a few things have been trailed, advertised, and a few things are up for debate. I guess I should insert a disclaimer that no one can predict the future. This is definitely not advice, but some people are more likely to be able to predict the future, and I'd like to think that you two are in that category. So let's just talk about something that the Labour government is going on about a lot at the moment, which is a £22 billion black hole. What is this?
I think essentially what this is they obviously looked at all the figures or had been provided with figures to come up with their election manifesto. And in their election manifesto, if you remember, they were very clear about, and they have been very clear in their messaging about being prudent and, not gambling with the UK's money. So they costed out a number of things, which were all fully costed by plans they had to put in place. But I think since they've taken power, they've obviously identified more, and we've subsequently had some public sector pay uplift, which the right-wing press are totally against. But actually, if you compare with what's happened in the private sector pay-wise, it's only comparable, if not, it's not even comparable still. Yeah, but that's the right-wing press for you. So they've obviously have to factor that. I mean, obviously with these things, 22 billion, it's a big number, isn't it? It's a huge number. Government spend is huge. Government debt is huge. So it's a lot of headline grabbing at the moment, a lot of messaging around. It's all going to be tough. And we'll have to see how tough it is. I suspect part of this is let's give a really bad message, so that when the budget comes along, everyone goes, oh, that's not as bad as we thought. Albeit there will be some significant changes, I would imagine.
Yeah, and something that Ed's been talking about for, it seems like years now, is that the current tax burden, i.e. the taxes that we already pay, is already really, really high. So Ed, tell us about that, and then let's talk into what's not going to change. But the tax burden is already high, right?
Yeah, absolutely. It's currently the highest tax burden since the Second World War. I think the predictions were that whichever party won the election, that burden was only going to rise. A big part of that is the fact that they've frozen all the tax allowances, the personal allowance, the tax bands, and that's both parties have said that's going to stay the same to at least 2028. So whichever party won the election, we knew that the tax burden was going to rise. And as I say, it's already the highest it's been since the Second World War. But of course, Labour are now saying that they've discovered this £22 billion black hole. And I think all the messages, as Andy just said, all the messages have been, including the recent Labour Party conference, is that there's going to be some short-term pain, hopefully for some long-term gain. So we are all expecting that tax burden is going to go up even further going forward.
Yeah, and if we take Rachel Reeves at her word, which we've no reason not to, she's already said quite a few things that will not change. So the scope for things that will change is actually quite narrow, which is kind of going to help us to try and predict the future today. But before we do try and predict the future, what do we know that will not change most likely? What have they already said they're not going to change?
So the big thing that they definitely said they're not allegedly going to change is they're not going to increase the tax rates on income tax, national insurance, and VAT. I think they've also at some point down the line, as we mentioned, corporation tax as well isn't going to go up. The headline rates, that is. That isn't to say they're not going to make any changes at all to any of those things, but they certainly said that they have no intention of raising those rates, allegedly to protect the working classes, or the working people is what they said they're going to try and protect. So they've certainly said those four taxes are not going to be increased. As I say, they may change, but they're not going to increase. They've also made a couple of other smaller announcements about what they're not going to change, but those are the kind of the key ones.
I think what's important to say, though, is they've been very careful with their wording here. And we've always said in the past, it's income tax, as Ed has just alluded to, in terms of you cannot change the rates. So the basic rate can be 20%, the higher rate 40%, and then moving to 45%. Different rates apply in Scotland, obviously. What the previous government did, and what clearly this government are going to do, is continue with this freezing of the tax bands. So that is this of what's called fiscal drag, which is therefore automatically bringing more tax in, because as your pay goes up, it puts you into higher tax bands, and therefore you pay more tax. So that's, I think that's almost a given, and that's going to continue, and they've already preempted that by saying it. But whether that then continues throughout the full length of the current term of the government, rather than just simply to 2028, we'll need to see. I think the second one, national insurance, again, said there's going to be no changes in the headline rates of national insurance. But what we have to remember is national insurance is only applied to certain things, and it's applied to employment and self-employment income. They could well extend that to maybe dividends from companies, potentially. So if you've got at the moment a limited company through which you're trading maybe your private practice through, at the moment, if you take a dividend out of that company, yes, you've got income tax to pay at dividend rates, but you haven't got national insurance to pay, and they could potentially apply national insurance there. So I think what we're going to be looking at is not the core headline rates, which is what all the papers always pick up on, but actually what it's being applied to and the scope of it.
Yeah, on that note, Andy, one of the again, all rumours go around, but one of the big rumours swirling around is that they might apply national insurance for the first time to rental income. That's apparently a thing that people are saying. So again, as you say, only at the moment applies to salaries, self-employment profits. But, at some point they may, of course they may not, but they may apply that to rental income. There's also talk about, I think national insurance ends when you reach the age of 65, I think, or was it? I can't remember, 65 or your state retirement age, but either way, there's also talk about applying national insurance to people that carry on working their salaries beyond that age. So that's another thing they could do without breaking their pledge not to increase the rates of national insurance.
Yeah, and I think this fiscal drag thing is a great example of stealth taxation, because the rate hasn't changed. It doesn't sound that bad. The threshold hasn't changed, but I read somewhere the other day a nice little animation that the 50,000 threshold, had it continued to rise just with inflation, would be now about 58,000. So it is fiscal drag, stealth taxation. It is affecting everybody. Okay, so they've got a bit of a limited scope on things that they could change there by what they've said. But what about things that are, absolutely ripe for change, in our opinion?
I'm not sure I'd say ripe for change, but what are the targets for change might be the better question. Not to take your questions apart there, Tommy, but what we don't want to say is putting forward, these are MedicsMoney's proposals to increase tax. This is what might well happen. To me, the ones they haven't talked about, capital gains tax, inheritance tax, and to me, pension tax relief, and maybe some of the investment tax or investment saving schemes that are available, which come tax free, would be things they could be looking at. So I guess it's where we start.
Well, the reason why I was saying ripe for change, and I definitely take your correction, I don't want to see any of these changed, but capital gains tax, it's a bit of an unusual tax. Ed did a bonus session to our course community the other day, and I actually learned quite a lot about it. But I guess the standout change is that the rates of capital gains tax are not the same as income tax. And there was quite a stark demonstration of that last year when Rishi Sunak and Keir Starmer both published their self-assessment tax returns. And they both earned around a similar amount, but Keir Starmer paid 3 times the amount of tax. And the main reason was that his was coming from income and Rishi's was coming from capital gains. So briefly summarize capital gains and tell us why it could be on the chopping board.
Yeah, I'll tell that. So yes, I mean, capital gains is a tax on any growth or profit that you make on an asset that you sell. And the rates currently, as you say, are much lower than income tax. They're 10% or 20% unless you sell a property, a second property that is, in which case they're 18% or 24%, depending on whether you're a basic rate taxpayer or a higher/additional higher rate taxpayer. So if you make a gain on an asset, you will then pay capital gains tax. Now, Labour have been very, well, I say clear on their wording, but they've said they're not going to, they want to try not to target or tax working people. Capital gains tax is seen as a tax on the wealthy, which I'd argue isn't necessarily true particularly, but certainly it's more likely to affect the wealthy. And unlike the Tories, who said before the election, we're definitely not going to increase capital gains tax, Labour have made no commitments on it at all, bar one, which I'll come into in a second. But therefore, as you put it, Tommy, it is one of those taxes that there is scope for them to change. I wouldn't say right for change, but they can definitely change it. They could increase the rate, but there are people out there that are speculating, again, it's all speculation, that they may even equalize the capital gains tax rate with the income tax rate. So whatever your marginal rate of income tax is, there are rumors that potentially that might be your capital gains tax rate as well on the profit on any assets that you sell. Whether they go that far is another matter, because they have also spent a lot of time commenting on how they want to help us all generate wealth, increase investment in the UK, and so on. So you could argue there's a bit of a mismatch there, but certainly that is what they're saying. The one thing they have said they're not going to do, they were quite clear about it, is that they're not going to put capital gains tax on principal private residences. That's one thing that they have ruled out. I think there was it wasn't a deputy leaders debate, but Angela Rayner and I think Penny Mordaunt had a debate where Penny Mordaunt said, to Angela Rayner, are you guys going to put capital gains tax on people's private residences or primary residences? And after that debate, Labour were quite clear. Keir Starmer said, we're definitely not going to do that. So that's the one thing I can think of in terms of capital gains tax. They've quite explicitly said, we're not going to change. But everything else is kind of fair game, to be honest.
I think I'd caveat that, though, they also said they wouldn't remove the winter fuel allowance from
That's very true.
So
that is very, very true.
I think anything's up for grabs. What I would say in terms of capital gains tax, I'm old enough to remember when capital gains tax did used to be taxed at marginal rates, but it was completely different then, because at the moment the gain is simply purely the difference between what you pay for something, an asset, and what you bought it for originally. Under the old rules, when it used to be taxed at marginal rates, what you were allowed is the fact that you were, the opening rate. So if you bought a house 20 years ago, it's obviously gone up with inflation since then. So there was what was called an indexation allowance applied to the base cost of the asset to reflect the cost of, over time, inflation erodes the actual real benefit of the gain. So this is the problem with any tinkering of taxes. It's not as simple as just saying we're going to move from a 20% tax rate or a 28% tax rate on residential property and move it to 40-45%, because actually that then becomes actually worse than income tax at that point in time, because you haven't got any inflation protection. And I've also seen a document or several documents which come from HMRC when they've looked into this around actually the tax take on capital gains tax. You're not guaranteed to get an increase in tax take if you increase the rates, because people will just simply change their behaviours and won't necessarily sell as many assets as they would have done before.
Yeah, I wanted to just touch on that because I think it's a very boring title of a document, but I think it's quite interesting. So yeah, this summer I wasn't just sailing, surfing and having fun with the kids. I did actually have a look at this Direct Effects of Illustrative Tax Charges Bulletin, which Andy mentioned is from HMRC. And basically what they do is they model the effect of various different tax changes. Now, Rachel Reeves is a very smart lady. She's an economist by training, and slightly unusual having a government minister who actually has expertise in their chosen field, because we're just used to having health secretaries that have never worked in the health sector and don't seem to know much about it at all. especially don't seem to know much about how GPs work. But anyway, that's an axe to grind for another day. So the government's modelling, which I'm just showing on screen here, shows that in some circumstances, increasing capital gains tax actually reduces the tax take that they get, which is basically the opposite to what Rachel Reeves want to do, right? So if I was Chancellor, imagine that, but imagine I was, and I'd seen this, and this has been out since June or July, what I might do is lead everyone to believe that I am going to change capital gains tax. Everyone, crystallizes their capital gains in a hurry, and then at the budget, just go, surprise, guys, not doing anything, because the data shows that in most circumstances, increasing the capital gains tax, as we can see, actually reduces the tax take. So have I overthought it, and would I make a good Chancellor?
I think, well, you haven't overthought it. Would you make a good Chancellor? I don't know. I've worked with you for a couple of years now, Tommy. So if surfboards and kite surfing is the thing, then yes, you'd make a brilliant Chancellor. But unfortunately, the country doesn't run on going out kite surfing.
I'm going to throw that as a curveball, because I think like that could be a legit strategy. If you know that raising capital gains tax is not going to get you what you want, which is more tax revenue, what you could do is let everyone believe that it is going to happen. They crystallize their gains in a hurry before the budget, and then at the budget you just go, on capital gains tax, no changes, and everyone will be like, oh no, why did I do that?
And I can tell you that's happening. I live in an area where there's a lot of holiday lets, and the number of estate agent signs that have gone up since the election is huge. So that means me thinking second homers are going, right, there's other tweaks that have come in terms of council tax, etc. But to me, that's people going, actually, I'm not using this house anymore. Let's get rid. Let's crystallize the gain while I can.
That's my one budget prediction that she could be double bluffing everyone. If she is, that would just be genius.
Yeah, I think that there will be some tweaks. There's lots of capital gains tax loopholes around certain business investments, and to a certain extent, they've got to be smarter in making sure they're targeting the bits that give you actual real growth rather than things that are targeting just individuals' pure wealth.
Yeah. Let's talk about one which I really hope they don't tinker with, but there has been rumours, pension tax relief.
Yeah, there's a lot of chat around this at the moment with in the financial world. Pension tax relief is a huge, in terms of quantification, it's a huge amount of tax relief is given to pension tax relief every year. Obviously, that is then designed to give people pensions in retirement. So you've got to give some encouragement to saving. So, we're not, I doubt we would go to a situation where pension tax relief was scrapped altogether and we went to maybe a sort of ISA style system where you go and get tax relief on it going in and you don't pay tax when it comes out. I think that'd be a step too far. The problem with pension tax relief and making changes to it is there are so many implications and ramifications, and every different types of pension schemes operate differently. So, I've got a private pension scheme, a SIP, whereas you've got an NHS pension scheme, which is a defined benefit scheme. And, in Ed's case, Ed's in an employed situation. I know, Tommy, you're self-employed, but GP, but Ed's an employed GP, and his employers pay his employer's contribution. So if you say at the moment you get tax relief on your marginal rate of tax on the contributions you pay, in Ed's situation, if we've moved to, say, a 20% tax relief across the board, well, Ed's still getting these employer's contributions paid by someone else for him, how do you tax those? So it becomes quite complex of how you interact things. Okay. So I'm not thinking, although it could be, it has talked about, should we be moving to a lower flat rate of pension contribution? I think that would be really difficult to implement in the current system. I would suspect what they will do, and they're quite fond of this kind of thing at the moment, is say, actually, they're going to have a serious review of this with an aim to reduce tax relief. But it will have to be for lots of people to put into actually how to put that in place. The other issue around pensions is at the moment you can get some of your pension tax free. That's changed. So in Jeremy Hunt, I'll say carefully, Jeremy Hunt, a couple of years ago, when he changed the pension tax rate, he abolished something called lifetime allowance. And Labour said they were going to bring it back, and then they said they haven't going to bring it back. I'm not sure they won't bring it back some form, but he replaced that by what effectively a maximum tax-free lump sum that you can take out, which is approximately 268,000 at the moment, so quite substantial. I could quite clearly see them wanting to reduce that. Now, automatically, it would reduce over time by this fiscal drag, because if you get that limit the same, then over time, it would effectively reduce. But I could see them making some kind of active reduction to this, and there's a lot of speculation about them reducing it maybe to 100,000, because actually you did bring it down to that level. A lot of people aren't going to be affected. It's only going to be the more wealthy people that have got bigger pension funds that are affected. But clearly, when we talk to our medical client base, that is potentially an issue. When they've always made changes to pension like this in the past, they have put some kind of protection in place that we built up to date is kind of protected. Because it seems a bit harsh to retrospectively tax someone. So if I've got in my pension fund, if I've got a tax-free lump sum now of 200,000 and it comes to 100,000, overnight, I'm going to be taxed on 100,000. That changes my whole retirement plan. So it's going to be difficult for them to do it in one go. So I think they would have to do it over a stage period. So I think they will look at that. Because it's a target that's targeted on the wealthy. One thing, talking to sort of pension colleagues, we think is almost nailed on as a possibility is at the moment things like your death benefits in the NHS pension scheme, or indeed in my SIP. If I died at the moment, those funds go into my tax estate free of inheritance tax. Okay, and it's quite an interesting and useful tax planning tool, particularly for people that have got large SIPs. At the moment, it's an asset which really you can use to shelter inheritance tax, which can then be passed down to generations. So it's quite it's used almost like a tax planning tool in some cases. And I think they could block that, because actually, if you just had it part of your estate, if you look at someone dying at the moment, if it passes to your spouse, then there's no tax to pay anyway. So in a kind of family situation, it wouldn't actually change, someone young died, it wouldn't actually change anything, because that would still be tax-free in that estate. But for those tax planning schemes for elderly people, which are using it not actually to live off it, in retirement, but actually to use it as a way of getting wealth down generation, then I think it will be quite an easy target. And to a certain extent, I think it's got some merits about it as well.
Nice. Well, no, not nice, but good info.
Yes.
So we don't have to.
They've talked about annual allowance as well. Our dreaded annual allowance, which our listening base will know from days gone by. We've talked about this on podcasts over the years. At the moment, the annual allowance is 60,000. Still got tapering coming in at 200,000, which is going to cause some problems in 2024-25, particularly for consultants with, high NHS pay and high outside income. Annual allowance is still on the agenda. They could well bring that allowance back, but they do know the doctor issue. The doctor issue has been well and truly ground into government, that actually, if you start tinkering around with these things, it causes issues in the NHS. So whether they then look at different rules for private pensions versus different rules for public sector final salary schemes, go down that route as well.
Yeah. Lots of speculation. It's going to be interesting to see what they do. So we done capital gains, we done pension. Any other things that we think might change, and why?
I think given that Andy just mentioned pensions now potentially becoming taxable to inheritance tax, maybe inheritance tax is the next thing to talk about, really, because I think that's another one that is very likely to change in the budget. Inheritance tax is a tax on people's estates when they pass away. Currently, you can pass on up to £325,000 inheritance tax free, and also an additional £175,000 on your property if that gets passed down to your children. So up to £500,000 of your estate may be exempt from inheritance tax. But there's been lots of talk about Labour potentially increasing the inheritance tax rates and abolishing various exemptions, allowances, and so on. I think it was in March time, the shadow chief secretary to the Treasury said out in public that they we're looking to use inheritance tax to redistribute wealth and address intergenerational inequality, I think is what he said. So we know that IHT has a very good chance that they're going to potentially increase the rates. There's a good chance they're going to remove various exemptions. So, for example, there are exemptions on farmers passing down farmland to their descendants. There's talk about removing that. There's talk about removing exemptions on passing on shares in small companies onto people as well, which currently are exempt. I think that these are going to be quite tricky ones in some ways, because I think, for example, if you take shares, you take someone who owns shares in their own company. Currently, that's not on a stock exchange. If you pass that on to someone at the moment, there wouldn't be any inheritance tax. But if they do remove that exemption, it's going to be quite hard for a lot of people to end up valuing their companies in such a way that you can then get that value for that estate to then pay inheritance tax. So, like with a lot of things we said today, you can make some changes, but there can be some unintended consequences, because I think that would be that would cause a lot of complexity, a lot of problems for a lot of people. I think they were backtracking a bit on the farmer side of things. I know that won't affect any of our listeners, but just to say they have apparently backtracked on that, although who knows what they'll actually do. The other thing to say about inheritance tax is, at the moment, if you have an asset that has a capital gain on it already, and you pass on that asset at death, that gain gets passed on with the asset. So the value of that gain goes with the value of the asset to your loved ones. So there's no capital gains tax payable on death. So another thing that they're talking about doing, apparently, is actually applying capital gains tax on assets at death as well as inheritance tax. So you may see, if they do that, kind of a double taxation situation whereby you pass on an asset, capital gains tax is payable on the gain, and then there may be IHT payable as well on the rest of the asset that gets passed along. So that's another thing that we're hearing. Again, who knows what they'll actually do.
Yeah. I think Ed makes a really valid point, though, about the implications of some of these tax changes. The farming one's a really good example, in that actually, if you didn't have this kind of tax relief that we do at the moment, actually farming in some parts of the country would just collapse, because they are handed down generation to generation, and farms certainly in upland areas do not make much money, if any, at the moment, since we've come out of the European Union. So, there are implications actually that could then cause things, if we start overtaxing rental income, that potentially has issues for landlords, and landlords might actually want to sort out, it's just not worth being a landlord anymore. And that then reduces the housing stock. Yes, it goes back onto the market. Yes, then hopefully prices may drop for people buying, but actually it's a big form of social housing, is private landlords. And what you wouldn't want to do is restrict the supply of housing in the short term. So yeah, all this has implications.
Yeah, definitely. Okay, anything else that we need to mention about what might change before we get on to what you might do?
Yeah, again, I'll perhaps just talk quickly about ISAs. So ISAs are, as we all know, an investment you can put in to cash or shares, and basically the growth within the ISA is tax-free, and you can draw down on that whenever you want. So you don't get tax relief if it goes in, but it grows tax-free. And we have quite a growing number in this country of ISA millionaires, so people that have been putting in ISAs for, they've been around, 30 years, and been putting in steady amounts over the years, and they've grown into a quite substantial pot. Yet every year we can put now another 20,000 into ISAs, which just grows tax-free. They are a very good form of investment and a very good way of encouraging people to save. So I wouldn't expect them to remove ISAs, because I think they play a valuable part in the saving part of life. But what they could do is look at, actually, is 20,000 too much? Could we restrict that a little bit? And also, is there going to be, similar to we had lifetime allowance caps in terms of pensions previously, is there a maximum you can grow your ISA portfolio to, on which you can't contribute anymore? Now, the problem with these kind of things is they don't produce instant revenue. It's a long burn revenue here. It's not going to suddenly give Rachel Reeves 5 billion of her black hole back, because it's just going to be over time, because at the moment they're not getting any, they're not actually getting any tax from people paying into ISAs or giving away tax relief. It's growing tax free. So over time it will grow the revenue, but not instantly.
Yeah. Okay. Nice. Not nice. Are we going to briefly talk about BADR or business asset disposal relief, or do you think that's too niche?
Well, I mean, I think generally, maybe not talk about that specific aspect, but actually to get out of this predicament, Ed started off by saying we are paying them the highest taxes we've ever done. So we can't just continually up the tax rate in society. We have an issue in society in that actually we have a greater number of people who are not at working age anymore. So they are, retired, and therefore when you get into retirement, you become more expensive on the state. Simple age, you've got more NHS issues, you've got social care issues, you've got all kinds of things, and you're also not earning as much, so you're not paying as much tax. You're not paying national insurance, as Ed pointed out. So we've got an issue, but we've got to be able to make sure that the part of the working part of society is as productive as possible, because this is only going to get worse. It's not that we're going to suddenly have this huge reversal of working age versus non-working age. It's going to steadily get worse. I mean, the boom has yet to come on that. So we have to be more productive as a society. We have to be generate more wealth, and to be fair, Labour have been fairly clear that is the way out of this mess. Taxing people isn't this. We've got a short-term problem, but actually we've got to start generating economic growth substantially. And one way to generate economic growth is through offering people incentives to do that. So whether there is an incentive to reinvest in your company rather than take the money out, incentives to purchase or invest in long-term capital projects. So we just take the NHS, for example. The property stock is at probably its lowest ever, in general practice. It's crying out for significant investment. So there could be incentives for companies to invest in things like that, which will actually give them, give the country a long-term benefit, but also generates wealth, because then we're building again. We're employing people again. We're, buying supplies of people again. So I think the budget has to address that. It's got to be a budget for growth, to use government are fond of three-word statements. A budget, it has to be a budget for growth, because otherwise we're not going to get out of this mess. Final point, partly that goes back to your comment of, are they playing the game of making it sound so bad that people do things now, generate a bit of that short-term tax now, and actually when it comes to the budget, everything will be slightly rosy.
I mean, I don't have any complex tax predictions, but that is my prediction of what they're going to do. Like, this is obvious that what they're doing to me, but we'll find out. That comment might age very badly, or it might make me look cleverer than I am, quite frankly. Okay, so you two have long since hung up your spreadsheets, calculators. You don't have any clients, because we get this question a lot. If you look in the YouTube comments, it's like, how can I contact Ed, or how can I contact Andy for advice? You can't, except to say that we do have our courses, which are starting soon. So if you're a GP, we've got our GP partnership course. And if you are looking to improve your finances by all doctors, and we have our financial wellbeing course, and you can find those at medicsmoney.co.uk/courses. So you haven't got any actual clients, but we are doing those courses where we love doing them. But if you were advising your clients, what would you say or do?
So if you're investing in things like this, if you've got spare money and you are investing and you have always invested, caveat this is not financial advice, okay? This is just a podcast. So let's get that in now. So, if you do private pensions, you do ISAs, and you haven't used your ISA allowance this year, I will probably be thinking about, let's get this in before the budget. I'm going to do a private pension. Let's get this in before the budget, just in case they change the tax relief side of things. With private pensions, very much do, particularly if you're a consultant in 2024-25, who've just had the pay uplifts applied. Do check out your annual allowance tax situation here, please. Don't just do it on the basis of this podcast, because a lot of people will call my annual allowance in 24-25 because of the pay uplifts. So I'd be thinking about advancing those investments. Should you be retiring early? I think, with times running out, we've only got You're certainly not going to be able to get your NHS pension in payment before the budget now, but actually, can you get an application in? I don't know. It's a difficult one, that one. I discussed this at length with a financial advisor yesterday about the pros and cons behind this, and one of the good ones we work with. And it's just, yeah, he said, and the bottom line was, he said, can't advise, we've got ideas and we've got a target group of people that we think might want to do something, but it tends to be that kind of group that we're going to do it sooner rather than later anyway. So it's just advancing it. So you've got to be careful about making knee-jerk stuff on guessing what's going to happen. So I would do that. Beyond that, educate yourself. Okay, this is not to do with the budget. This is about, through life, we make so many mistakes financially, not deliberately, but just through life gets in the way, or we just don't understand things, and we haven't got time to understand things, which is partly what MedicsMoney is about. It's about trying to actually educate people to sort of know the circumstances where they need to get some help, know the circumstances where they can actually make some simple changes which have a tangible impact on their income coming into their family. So educate people. Yeah, let's not do cheesy selling courses, but actually that's what I like about the courses that we put on, is actually it's not us going, this is the total solution to life. Here we go. You follow this, everything's going to be better off. It's actually, these are the issues. These are the easy things to talk about. Let's talk about our budgeting, talk about our home life, how we run things, talk about actually where we can make some simple tax savings, which are legitimate, which are available. Talk about where we can invest sensibly to get the best growth, and talk about where the financial mistakes come. So yeah, educate people as well. But that's a constant thing, not a budget thing, but I think it's essential.
Definitely what you're saying there is just have a financial plan, plan for how you cover all those big areas that Andy mentioned, how to pay the right amount of tax, how to make sure you're spending your money wisely, how to invest for the future, how to protect your pension and learn about it, and so that you understand it and can utilize it. And yeah, we're loving the courses. I mean, because we haven't done a podcast together for absolutely ages, but it seems like I see you guys almost every day at the moment doing the courses, which are going really well. So we're really enjoying doing them, and we've had some great feedback. So we're doing another whole round in October. So check those out if you want to take it to the next level. Ed, you used to advise high net worth individuals at PwC before you wisely decided to become a doctor. What would you say?
Yeah, I mean, I guess. So first of all, just like Andy said, you shouldn't do or not do anything based on this podcast, which is just thinking about what might happen. I guess, and again, just like Andy said, if you have certain things that you are going to be doing anyway, is there any scope to bring those slightly forward before the budget? Okay, so for example, just like Andy said, if you have some money which you're going to be putting into your ISA, and that is a definitive thing you're going to do, why not put it in potentially now before the budget, just in case there is a reduction in the amount you can invest from that date, for example. If you have an asset that that's standing at a capital gain, and you definitely know that you want to sell it, and you're not doing it just because of tax, but you're doing it because that is an asset you want to sell or have to sell or need to sell, whatever. I mean, I think it's, we can't predict anything, I think, but I think it's fair to say that the capital gains tax rates aren't going to go any lower. So if you do have an asset that you are going to be selling anyway, it might be worth thinking about selling that before the budget, if you can, rather than waiting until after the budget, for example. So again, I think it's more about not necessarily changing what you're definitely going to do, but if you might want to think about whether there's any scope for doing things a little bit sooner than you might do. So yeah, I would definitely think about that. And we are seeing, at the moment, according to the press, if you can believe the press, but we are seeing people, selling up assets. We are seeing people putting money into their ISAs at the moment in time. We are seeing people that are looking into taking out a tax-free lump sum now, in case it gets that the amount we can take out is reduced later. So, there are people that are changing their behavior in such a way that they are doing things sooner rather than later. And that is something, for people to consider. But just like Andy says, you need to educate yourself about these things. You need to be fully aware of the implications, not just about the tax, but about everything that might happen if you do any of these things. Okay. So, I mean, that's what I would advise my clients if I were at PwC, but just like I'm doing now, I would caveat everything very, very heavily. Yeah, that's what I would do.
Yeah. Awesome.
Can I just add one point on the financial education side? So again, this is a second cheesy sell pitch, but this is to anyone who sort of works in the sort of educational side of the NHS or looks at educational budgets and things like that. To me, and I know slight conflict of interest here, to me, financial education is part of actually a really strong workforce plan. So if your workforce have control over their finances, understand their finances, particularly around things like the NHS pension and the asset that brings, they are more likely to be stable in that respect in terms of, looking at employment opportunities, etc. So I would encourage anyone who does sort of work in those education roles to think about that, to think about how you support your workforce in terms of gaining that knowledge.
Yeah, I'm supposed to do a sales pitch, and Andy's stealing my thunder very well there. Yeah, I mean, there is in the NHS Forward View or something, they recognise that financial education and well-being is a problem. And so, yeah, I will just reiterate that if you are in that position. Okay, I was going to do a little sales pitch at the end, but you just stole my thunder. So I suppose to recap, I would say this is just what I call crystal ball territory, which is, with all due respect, nobody can predict the future. I think you've made some really good points today, but no one knows what's going to happen. And I tend to not make any decisions based on crystal ball predictions. I think just what Andy said, just keep to the basics, keep to your financial plan, keep looking at your spending, seeing if you can trim anything that you don't need. Keep looking at your tax position and thinking, is there anything that I can do? Look at investing to grow your wealth. Get a handle on your pension. And the real thing is that none of this is a one-off. It's about a lifetime of good financial habits. And if you have good financial habits and you are a doctor, you will be okay. But if you don't and you do nothing, you're going to be working longer and going to have less, unfortunately. So education, and you're in the right spot to be educated because listening to the podcast. But if you do want to take it to the next level, go to medicsmoney.co.uk/courses. And those two courses, the one for GPs and the one for all doctors, they are the last courses this year because I feel like we do need a bit of a laydown because it's been quite hectic. So check that out. And also, when the budget is done, we will, of course, be releasing a budget podcast to recap all the changes that are relevant for doctors. That will be going on to our email list as well. So if you're not on our email list, I think we're coming up to 60,000 doctors now, which is a bit scary when I accidentally make a typo that doesn't get corrected. Go to medicsmoney.co.uk/join. Don't forget to subscribe to the podcast. If you're watching on YouTube, hit the like button and the subscribe button. And if you're watching on YouTube, leave us some comments in the comments section about what you think the predictions are. What's your predictions? And what do you think about my double bluff theory by Rachel Reeves on capital gains tax? Otherwise, let's catch up on the next episode. Thanks, guys.
Cool.
Thanks.